All right, so let's look at Best Buy, BBY, please.
What time frame do you want it on?
Daily's good.
Daily's
Start
good.
with daily.
Okay.
Daily's fine.
Daily's good.
You know,
Yeah.
Greg, I brought the stock up yesterday for the Queen's Court, and I got my head lopped off. I might have needed your help on this one.
Oh,
So,
yeah?
yeah.
You might not, he definitely didn't need my help because I'm the one who
Well,
caused his head to get chopped off.
The king is here, so
There you go.
we're using this one anyway. So just pattern wise, trend wise, if we look at maybe the 3-year weekly map.
Yeah.
So you can see that we've had a nice run. It's up there consolidating. We're looking for a breakout of that consolidation. We're on the weekly chart there. We've got a inverted head and shoulders. Even a more recent cup and handle there. I really just like the setup again, both from a weekly perspective, and then if we go back to the daily chart, it looks very nice as well. So for me, this is just a breakout opportunity. We're right around that 120 mark. We're actually at a buck 2013 today. Looking for a breakout, just to probably, I think it's around the 121 if I remember correctly. I'm looking for that breakout. It's been strong for a while. It's consolidated. It's had some movement. It is a mover, which I like. That's the other part I do like about it. And the other part, we've got some time between now and earnings, which is fine. The reality is it's just your simple breakout pattern type trade. And so now what I can do is when I see a trend or a pattern I like or both, then I can go in and I can start to think of this. How can I get this creative from an options perspective, right? And so the two ideas that I typically look at, or not typically look at, but the two ideas that I think about are, do I want to do a directional trade or do I want to cash flow this? Okay. And fortunately for Best Buy, it actually works out well in both ways. So what I want to do is I want to build a credit spread and I want to build a debit spread, and it can be played either one of those two ways. But this is the kind of the way that I like to break these things down. The spreads are not that complicated. If you're lower on that scale that you guys had, it might take a little bit of a little bit of practice, a little bit of learning to get through that. If you're a little bit higher on the scale, this is probably going to seem very simple. But in my trading experience, simple tends to work really, really well. So the first thing I want to talk about is below these two moving averages here. I believe you got the 20 and the 50 there. So if you look at that $110 level there, we've got a couple of levels of support there before we get to that 110. So where I'm going to start with this is I want to go into the trade tab. If my buddy Matt's still here, I didn't lose him.
Oh, it's all right. By the way, I'm looking at the chat here, and Jonathan reminded me that I got lobbed yesterday on this stock because of I talked too much about it, Greg. And Emily did not like that. She wanted to get right down to the point. I'm liking the technical analysis here, obviously, in those long-term. That's one of the things I did like about is the long-term 3-year range that you were in, Greg, that we could potentially break out of those multi-tops that we were seeing. But then, and so on the weekly chart, you got kind of clear resistance that you can clear through. And on that daily chart, you do have that higher pivot, low that we're developing, which is kind of that little cup and handle type of situation. But anyway, you're thinking debit spread and credit spread, and you're starting with the credit spread. Is that right?
Starting with the credit spread. So like I said, I've got some support there of the two moving averages. You've got some support above the 110 there. So I like the 110 level. It gives us enough kind of cushion there where I think we can make a decent trade here. So I looked at the weeklies. The weeklies didn't impress me that much. There was the bid-ask spread was a little bit wide for me. So looking at the when you start to get out to those other, get out to the further out of the money strikes, gets a little wide. So I'm okay with going less than 45 days, and that May 21st there, the 4 days out there looks pretty attractive. So if we go from a 110, sell the 110, buy the 105 vertical. You're looking at a minimum of 63. You're probably going to get about 70 cents out of that for a $5 wide spread. So you're well above your 10% that you need. A decent little rate of return there. And like I said, you got a $10 move away where you're still away before it touches your short strike. You've got that breakout potential, and you've got those levels of support plus the moving averages. So I feel that you've got a decent cushion there. And so this can easily turn into a cash flow trade as opposed to the other way that I want to go is the more directional trade, right? So, you know, when you start to break down these things, and again, there's so many different things I could have looked at, you know, for directional. I could have went risk reversal. I could have done all these different things, but I kind of like to keep it simple, and a credit spread for this thing is pretty simple in its own right. So that's kind of the first place I looked. Now, the second place I want to go with this is I want to go to the June expiration. And I'm looking now, instead of a cash flow trade here, what I'm looking for is strictly some delta out of this thing. So what I want to do is I want to buy the 120 call option, and I want to sell the 130. And if you look at that trade, you're going to come out and it'll be cost you, oh, that's a little much. Should be around $3.50, I think.
Which one do you want to buy, Greg?
So I want to buy the 120 and I want to
Okay,
sell.
so you want to buy the 120 and sell the 130?
That's correct.
There you go.
So you're
360.
Yep, $360 into the trade. So that's probably going to catch most people's pain threshold, you know, unless you've got a smaller account. And if you look at the risk graph on this bad boy, you should have a clear 2-to-1 risk reward pretty easily.
Okay. Now we critique, I think, as we look at the risk graph. Let's take a peek here, Matty. Matt, you want to go first? You want me to go first? I got a few things to say.
You go first.
Greg, I love the chart. I brought it up yesterday. I'm interested. There's a couple things. Number one, as I look at the option chain and I think about where it is, you look at the implied volatility at the bottom. Matt, back on the chart for just 2 seconds. Matt has a very simple but very helpful indicator added at the bottom called implied volatility. And it measures it going back and forth, up and down over time. Now, we're currently on the rise at 43%. That doesn't necessarily mean it's at the peak of where it's going to be, because it has been near 50% as it goes into earnings the last 2 quarters. I do expect volatility to continue to rise over the next 6 weeks as, you know, Best Buy has earnings mid to late May. So IV rising in general is going to have me leaning towards debit type of spread, because a bull call spread is going to have a positive vega. We'll geek out here for a minute. Positive vega implications which will benefit from that. So it's like a tailwind. It's a helpful kind of condition behind that equity. So my first instinct is to lean on the debit side for a couple reasons. IV is one of them. Second is this is a delta-based play. I'm not playing it here on this red candle. I'm not playing it here, you know, until I get confirmation on exactly where that breakout is going to happen. And there could be that a technician, literally, they could spend a few minutes looking at all those different peaks, determining where their confirmation is. Reality is, though, I'm only playing it on confirmation. So that would be that. And when I think about it
Very
like that,
quickly, though, confirmation is subjective on this. The range is 120 to 125, which means you can start allocating in the range on a bull call spread.
so that's a pretty good window there, 120 to 125, and there is some subjective nature to it.
Well, it's only because it's the range and you're talking about a spread and not some type of pinpoint aggressive directional play. So if it was buying a call, I would say wait till the break of 125. It's a bull call. I think you can start dipping your toe in a little bit in that 120 to 125 range with the call sign.
With this long-term kind of bottleneck, when you think of the weekly chart as well, Greg, I actually would open your spread a little bit more myself. You know, so 120, 130, that's a pretty good spread. 120 is going to be in the money if you're buying on confirmation. So the delta is going to be in that 55, 60 range. There's no critique about that. That's within the window of most bull call rules that you're going to see in playbooks like Attack with Trading. I personally would wait for the upward confirmation. I would play the 125 like 140. Give it like 15-point window, get a little bit lower cost, but a bigger window. That if I did catch a directional move, sounds like I'm more willing to play this a little bit more aggressive than you are, Greg, which isn't surprising. But
I actually feel you're doing it a little bit more conservative, waiting for confirmation, quite frankly, because and which means you might miss the trade, honestly. I mean, that's what it means, because you do have earnings coming up within 6 weeks here. I think the equation for me, however an option trader wants to buy this option or sell this option, I mean, that's just going to be a subjective conversation between option traders. But, and quite frankly, you're going to go look at, open interest and volume on that day you make the trade. But when you're looking at it right now, trying to decide, do I want a credit or debit? I think that's the first question you have to answer, right? Do I want a debit? Do I want a credit? Do I want to take do I want to go for the home run? Do I want to take the probability? And I think you nailed the answer when you were talking about volatility. And when we're looking at when you're looking at the combination of price, you're looking at a breakout trend, you're looking at a breakout. Those from a trend perspective, you have an increasing support coming into a breakout out of a prolonged consolidation period. You should be looking directionally at this point on a chart that looks like Best Buy. You should be anticipating taking action on that breakout. 100%. For people that are going to lob a naked put here, I think you're doing yourself a disservice, quite frankly. You could have been doing that at any point, at any time on this chart, cash flowing. There are times you got to pick up the big britches, pull up the pants a little bit, tighten up that belt, and get directional. And when you have an increasing support coming into a potential breakout on a quality company like Best Buy, sometimes you just got to take the directional risk, credit traders. That's what I'll say to that. Also, when you're talking about volatility, understanding volatility is one of the most important things you can do as an option trader. I talk about shifting volatility from a technician's perspective quite a bit when we're breaking down analysis in the halftime report. And it's certainly important from a technical perspective. It increases the probability of a directional move, no doubt about that. Or it helps you identify when trends are beginning versus when trends are over. Shifting volatility is so important, but shifting volatility in the stock market is a micro conversation to what option traders talk about when it comes to volatility, since it's the second most important thing that you can understand in an option contract. I would even put understanding Vega as a higher in the priority list than understanding Theta, because Theta, there's not much to understand. If you buy a short-term option, you're going to lose money. Very simply put, Theta is a depreciating asset. It's not hard to understand. Volatility can be. Understanding why volatility moves is very important. Volatility can move for any reason, but there are some cycles in the volatility scale that we do look at as option traders. And yes, this is old hat for some veterans out there in our community. So bear with me as I discuss things that you know very, very well, but to new traders, they may not. Now, Tim, you spotted it because you're an old trader. You spot these things. You said volatility was in the mid, but you expected to go higher. And the reason is very simply why.
Earnings is in front of us, and that's the volatility.
And let's make this as simple as can be. You see that blue question mark dot right there, guys? That's an earnings. That's the anticipated earnings. Now, earnings is one of the most uncertain moments in time, and traders don't. This is what people don't understand when they come to the world of trading. We don't care if prices go down. Mark, when prices go down, do you celebrate or get upset?
I actually celebrate.
You actually celebrate. And to somebody new, that might seem weird, right?
Yeah,
It's
and
weird.
I'm a perma bull. I don't almost do.
And you're a perma bull.
Yeah.
Like, you're even more of a perma bull than me.
Yeah, no, I mean, about the only bearish trades I ever do are like buy protective put if support breaks on stuff I have.
Okay. As a perma bear, you will look to buy a put option to protect. And that's what happens here. See, people aren't going to get in and out of long-term positions. They never do that. And they don't do that for a variety of reasons. As an owner of a company, you want to be an owner of the company long-term, not short-term. But also, when you get rid of an asset, it creates a taxable event. And who likes to deal with taxes? Anybody? Anybody?
Nope.
Anybody?
Bueller.
Okay, so nobody wants to deal with taxes, so we don't like having taxable events. Well, getting out of a profitable position will create a taxable event. So instead of doing that, what investors will do is they will buy put options to hedge the position to reduce the exposure. And so, for example, when you're looking at, if I owned 100 shares of Best Buy and I'm looking at this on a risk graph here. So if I just go ahead and add 100 shares of Best Buy, I'm vertical, right? I make money as it goes up, I lose money as it goes down. Well, vertical risk graphs are perfectly fine if you can have a probability scale on or a probability edge on your technical analysis. You're perfectly fine, right? But we'll never do 50-50 scenarios. We'll get our edge on the chart. Right here, when you're looking at this risk graph, you got a 50-50 scenario. Price goes up, price goes down. That's 50-50 scenario. Tomorrow, we're going to wake up. It's going to be Thursday at 9:30 a.m. Eastern Standard Time. The market's going to open, and it's either going to go up, down, or it's going to go sideways, and that is absolutely the only promise any trader can give you. If you hear anything other than that, they're lying and trying to sell you something. Outside of that, traders talk in terms of probability analysis. And so everything is 50-50 until you find your edges, and your edges are defined on the chart. I feel we have an edge based on what my reading of the price action. I feel we have an edge, quite frankly, not because we're hitting resistance. We've hit resistance here, we've hit resistance there, we've hit resistance there, we hit resistance there, and all three times, boom, came right back down. I feel we have an edge because the market's showing me their hand right here. They're showing me their hand. That got stuck multiple times. See, last time it did this, we came all the way down. This time, it tried. It got stuck. It tried again. It got stuck. They capitulated. Now the bulls are rocking. I feel we have an edge on that. I don't feel we have an edge just looking at the risk graph. I feel we have an edge because of the chart. And so that's where your edge lives. And so when you're looking at this risk graph, everything is 50-50. And so in front of earnings, which, yes, traders will always assess, real traders will always assess earnings as a 50-50 proposition. You don't know what the company's going to report. You don't even know what the ranges of analysis that we're going to be talking about in 6 weeks from now of what we expect Best Buy to do, because we don't know them. The market doesn't know them. Those projections are going to start coming out, and they start coming out before the earnings. And so what happens is when an investor, a hedge fund, an institution gets slightly concerned about this 50-50 scale for whatever reason, what they try to do, they don't capitulate. They don't duck their head in the sand and say, well, inflation's going to come at me, I'm not going to worry about it. No, they're going to go do something about it. And instead of capitulation, they hedge. Consumers capitulate to fear. Traders hedge fear. And so when you're looking at the hedge, the natural hedge is to simply go out in time, and I'm not going to apply all the rules. I'm just going to show you the hedge. And so what traders will do is they will go buy a put option to adjust the left-hand side of the risk graph. And what will happen now, let's take the hedge off. Now you see the potential loss, you see the potential gain. By adding the put option, you give up some of this potential gain by locking in the risk. And as traders do that, the market knows they're doing that. The market's not going to let traders be creative for free. As it gets closer to the earnings date, the market maker will start adjusting the volatility scale higher and higher and higher to ensure that Coach Mark, if he wants to insure his Best Buy, he's going to have to pay higher premium a week before the earnings than I'm going to have to pay 6 weeks before the earnings. Because 6 weeks before the earnings, there's not a lot of fear, there's not a lot of concern, there's not a lot of volatility. It's like a hurricane 6 weeks from now hypothetically may hit the coast of Florida versus a hurricane 1 week from now hypothetically hitting the coast of Florida. I can more easily project the hurricane a week from now than I can 6 weeks from now. Can we agree with that?
Yeah.
Same thing from a risk perspective in the marketplace, which means as the market maker is not just going to allow people like myself, Greg, you, and Mark to go buy a put option 1 minute before the earnings announcement and be able to protect that asset class at 3%. That's you're going to have to pay 10% to do that. Well, today I can do it for 3 to 4%. And so as what happens as the event gets closer, this blue line will go up. And so just simply that technique alone will help you understand why Tim immediately chose the debit transaction over the theta transaction, because, and again, keeping it as simple as I can, this blue line going up hurts the theta trade, but helps the debit trade. And so there are times to theta and there are times to delta. This would be one of those times you want to take advantage of directional posture, given the fact that your analysis on volatility is going to go up and you have an edge on your chart with the increasing support coming into a very important breakout condition. That is the reason why you immediately chose the debit trade over the theta trade. Would you agree with that, Tim?
100% exactly where my head was.
I just wanted to detail that for people.
And
That
I
was
hope
it.
that helps. That was very, very good there, brother. I do appreciate it.